Walk onto a trading floor or check any retail forum today, and you'll see the same behavior. Average investors are buying into equities at near record highs. They are chasing the momentum of the terminal phase of this bull run. However, looking at the activity of corporate insiders, the executives and board members who know their company's balance sheets best, reveals a different story. These insiders are currently executing record volumes of liquidation, selling off their own shares even as the public buys in. This massive exit by smart money is happening because 40-year market veterans recognize a pattern that has repeated across 3 centuries of economic history. Every major financial crash since the 1700s has been preceded by 4 specific signals: fantasy pricing, paper riches, overconfidence, and dangerous assumptions. For the first time in over 4 decades, all 4 of these historical precursors are flashing simultaneously. Today, dangerous assumptions and overconfidence have manifested as a form of tech hubris. It is driving the extreme valuations we see in artificial intelligence and cryptocurrency. This psychological mania mirrors the dot-com era, where investors fell for the recurring, fatal assumption that the old rules of economics no longer apply. It is the belief that this time is different. While tech stocks soar, the precursor of fantasy pricing is becoming visible in physical assets. If you look beneath the surface of the equity markets, you'll find a vacuum in commercial real estate. This chart shows the delinquency rate on commercial mortgage-backed securities for office spaces. It recently hit 11.7%, a full percentage point higher than the absolute peak of the 2008 Great Financial Crisis. We see similar fragility in the automotive sector. To keep sales moving, over half of all vehicle loans are now being stretched out to 6 or 7 years. These long-term loans mean that a majority of consumers are now upside down, owing the bank more than their depreciating car is actually worth. The economy's apparent strength is a fantasy built on a foundation of toxic debt and irrational hype, completely detached from the reality of these physical markets. This leads us to the final signal: paper riches. This diagram represents the total pool of domestic assets in the U.S., which is now dangerously concentrated. Currently, the top 10% of American earners control roughly 86% of all domestic assets. That leaves the bottom half of the population effectively disconnected from the capital markets, with 2/3 of the country now living paycheck to paycheck. This consumer base is being hollowed out by a 20% increase in systemic costs, including utility rates and insurance premiums, leaving the broader economy without a solid floor. In 2008 and 2020, the government printed trillions to stop the collapse. But today, the fiscal and monetary authorities lack the capacity to inject another $5 to $10 trillion without triggering a hyperinflationary spiral. Geopolitical shifts and aggressive trade policies mean that American consumers and importers are now paying the cost of global tariffs, further paralyzing mid-sized businesses that can no longer forecast their costs. With the consumer base depleted and the federal safety net effectively exhausted, the economic foundation beneath the wealthy is actively rotting. We have entered the most volatile stage of the everything bubble, a state where stocks, bonds, and real estate are all at risk. The system can operate under this extreme stress for a short window, but it will only take a single unforeseen macroeconomic event to act as the catalyst that brings the entire house of cards down. Because of this fragility, your primary objective must pivot immediately. The focus is no longer capital appreciation, it is aggressive capital preservation. For gold, the key inflection point is the $3,500 threshold. At that level, the economic math for senior gold producers changes entirely as they begin generating unprecedented free cash flow. Given the current debt environment and the loss of monetary hegemony, the long-term target for gold is now moving toward $5,000. Silver presents an even more significant opportunity. Because industrial and investment demand is outstripping mining output, a fundamental supply-demand deficit is forming. This sets the stage for silver to decouple from gold and lead the next resource run. As silver decouples and catches up to the scale of the deficit, a trajectory toward triple-digit pricing becomes a realistic outcome. The retail public is buying equities at the absolute terminal phase of a bull run. To preserve your wealth, follow the institutional move into precious metals and the junior resource sector before the catalyst hits.